We're going to get straight to the conversation. We've talked already about how Africa's growth story is essentially oversimplified a lot in the media, and that's where I work. And so we want to talk more about the landscape today for this panel. It is very conversational, so I encourage everybody that's listening right now, take some notes. We may not be able to get to all your questions today, but out in the coffee break, which will happen very soon, thank you, within the hour, we can have that dialogue, and then we can also take it online. Because I'd rather you guys be listening right now as opposed to tweeting or searching up who our speakers are, which I'm going to get to actually right now. And I may as well, no, I'm going to save you for a second. I'll start with Carlijn Nouwen, who is the partner in Dalberg's Johannesburg office. Carlijn is the global lead of Dalberg's Advisors Inclusive Business Growth, and that's your expertise. She focuses on financial services, healthcare. You also spent 7 years at McKinsey, so I'm sure there's a lot of students here that would be interested in that. And I asked everybody for a fun fact so that you know these are real people up here. You can chat with them later. So fun fact about Carlijn is that you just in December over vacation, not really a vacation for most, but you spent, you went for what, a 3,000 kilometer bike ride across Cambodia. So there's a little fun fact. We're going to move on to Dr. Martyn over here, Martyn Davies. He's the Managing Director of Emerging Markets and Africa at Deloitte. He also leads the Japan and China Services Group at Deloitte, for Deloitte Africa. He's a visiting professor, not here, but at the IE Business School. You completed your PhD at 25, but that's not the fun fact. The fun fact is that this is a cyclist couch because he is the top-ranked veteran cyclist in South Africa, and he really wanted me to see his phone because he had a ranking that he just did a race this week, and he came in 1 minute, I don't know, 1:45 for the Strava King of Mountain Race. I have no idea what this is, but he really wanted me to know about it. Oh, sorry. So there you go. So there's that fun fact. And last but not least, we have Razia Khan, who's the chief economist for Africa and the Middle East at Standard Chartered Bank. You've been covering these markets for 20 years, so you're a veteran about this. And you also serve on the World Economic Forum's Global Future Council on Migration. You were named one of the 100 most influential Africans in 2015 by New African magazine. And I guess I asked for a fun fact about her, but she is an economist, so let's move on. No. She did tell me that her mission is to get everybody reading. Are you reading a book right now that you want to share?
Oh, it's fascinating, about monetary policy.
Oh, gosh. Be sure to ask her the title of that book when you're outside. And my name is Kristina, Partsinevelos, financial presenter from Canada. I did the alumni, or I'm an MBA alumni here, and I'm moving to New York soon to work for a network, Fox Business News. So let's start with talking about the economy. And I want to start with Martyn, and we're going to pinpoint on certain nations. So let's start with Nigeria. 2017 GDP growth came in at 0.8%, and then you had South Africa at 1.3%, so just barely out of recession. Let's talk about the growth potential for those two nations and then generalize it a little bit more for the rest of the continent. It's a big question, and you're going to start it off.
Sure, thank you very much, and it's good to be here. Just an opening comment, if I may, and in all my travels, there's no region like Africa where the aspirations of the young, you guys, are in such stark contrast to the political control of the old. And I think ultimately that's my conclusion when we're talking about our region. On your specific question is, we've had a really tough, I think we've bottomed out, arguably in the last quarter. But the last 3 to 4 years has been very difficult for the economies you mentioned. Sub-Saharan Africa, unfortunately and Devon was mentioning it a lot earlier, the focus on base of pyramid, and it's seemingly that Africa is viewed through the lens of an FMCG play. So countries with big demographics are attractive to capital, and those that have small populations are effectively sidelined or ignored.
Can you explain the acronym?
Fast-moving consumer goods.
Just so everybody knows.
FMCG.
Yeah.
So think sort of FMCG products, etc. And I think it's very unfortunate. So there's an over-emphasis, if you will, on 3 sizable economies, with 3 sort of anchor economies of the region. Nigeria, you mentioned, South Africa, Kenya, all of whom have been significantly misfiring and cannot get into gear in recent years. And I would argue, and I want to hear Razia's view shortly, is 2017 was probably the base year. We see an uptick in commodity prices of Nigeria, a bit of confidence coming through the system. South Africa, political renewal, we hope. I think we're still getting there. I think we're going to have a bit of a rubber band effect in terms of the sort of exuberance we've felt post-December and post the appointment of Pravin Gordhan and Carlijn in recent weeks. Reality will set in a little bit. But, and Kenya politically highly confused. So these three together, and those of you from Kenya in the room, you know what I'm talking about. But the last point I'll make is that, and I want to pick up what Yvonne said earlier, there's this nominal GDP headline growth figure, and this is what I'm trying to get my head around in our continent, and the leading question is, does the macro actually matter? Because we see these stellar, particularly in East Africa's case, these stellar high economic growth rates, but it's not translating into increased consumer spend and true development as you interpret it, i.e. embedded middle class societies in the economies in which these high growth rates occur. For example, you live in, anyone from Kenya here, hands up please. Kenya, Tanzania, same rule applies. Tell me if you think I'm wrong, okay? Is you have a 5, 6, maybe 7% growth economy. When you live there, I used to live in Asia, China, Korea, Singapore, these places. When you have such a high, robust growth rate, and I'll finish on this, you feel it. That growth rate is incredibly enabling to the national economy, to companies, and to personal careers. It's a massive tailwind. When you're living in a Kenya or Tanzania, you have these high growth rates, but it doesn't quite feel like it. Why? And I'm trying to figure out in my head this difference between the nominal high GDP growth rates and the reality in terms of development, bottom-up development on the ground. Is it leakage? Is it corruption? Is it efficiency? Is it lack of productivity gains? What is it? And that's what I'm trying to get my head around in terms of the growth trajectory, or development trajectory, more important, of these countries going forward.
Okay. And Razia, I know that he wants you to add a little bit more about growth, but I want to be more specific and talk about currency fluctuations that we've seen most specifically between 2014 and 2016. There were some huge drops. We know South Africa, the rand is doing a little bit better now. Tell me a little bit more about how the fluctuations have been hurting consumer purchasing capabilities, and then just talk a little bit more about those purchasing capabilities of African consumers. I know it's such a big question given how vast the continent is, but if you could touch upon that, please.
Sure. So maybe starting off with a little bit of macro context. What we've seen broadly in the sub-Saharan African region is this multi-year period of adjustment to much weaker commodity prices. At the same time, if we look back to when we were seeing really pronounced exchange rate volatility, that was 2015. Everyone anticipating that the Fed would soon be raising interest rates. They did at the very end of the year, maybe disappointing expectations for very aggressive tightening, but this had an impact across the board on different African exchange rates. To try to read more into that, we've got to look at the specifics of what happened in different countries. In Nigeria, with the collapse of oil prices, initially, there was this great effort to do anything possible to try to keep the naira steady. And unfortunately, some of the policy choices effectively meant that demand was very much more constrained. The way of trying to keep an exchange rate artificially high was to squeeze the real economy. The Nigerian naira was not allowed to adjust to the fact that the economy had seen this massive external shock. And that meant that there wasn't, to try to, not to use too much of the economist terminology, but an exchange rate is just a nominal variable. It's not a real thing. And what happened in Nigeria was that this shock absorber that would normally be fluctuating and absorbing the impact of that external shock couldn't play that role, and so it was the real economy that took on the pain of the contraction, the outright economic contraction that we saw in 2016, slowly coming out of it in 2017. Other countries have had very different experiences. South Africa, the rand seems to have been all over the place. Now a great deal of optimism. It's been one of the best performing currencies, if not the best performing currency globally, reflecting the political optimism. The difference there is that purchasing power is protected. South Africa has a very robust inflation targeting policy in place. And so whatever happens to the exchange rate, participants in the economy know that the Reserve Bank is going to be protecting their purchasing power through its inflation targeting. Ironically, it's those economies that have seen great volatility in their exchange rate, but have had this robust institutional framework where a central bank can say, we're going to be looking after consumers' interests. We are going to be doing everything we can to ensure stable rates of inflation. If that is a credible promise, it doesn't matter what the exchange rate does ultimately, that counts for a lot more in protecting purchasing power.
That was a brilliant last statement there, and I hope everybody's writing notes again so we can ask more questions specifically about that. And I'm just going to we're going to go from just purchasing capabilities or power of consumers and focus on these consumers themselves. Yvonne was talking about the population growth and how it can also almost be a boring story at this point, but let's talk about very recently the African Development Bank put out a statement saying that you look at population growth paired with youth unemployment and it's a ticking time bomb. And they did put an emphasis on private investment. Can you tell me a little bit more about the advantages of private investment in Africa? And I know that China will come up into that conversation.
Yeah, I won't raise China just yet.
Just yet, we'll save that.
Every opportunity for massive change holds in itself an opportunity for massive failure. So if you look at the youth bulge and the youth unemployment, yes, that is a ticking time bomb. Yes, as Yvonne rightly said, if we don't get it right and we don't create an environment in which these youth can fully deploy their own potential and live their lives to their fullest potential, they are going to revolt. But at the same time, it's that very same group that holds so much potential. Yvonne said it, the lady here from South Sudan, I missed your name, said it, life goes on. We look at all these macroeconomic factors, but these are millions upon millions of people who are trying to live a life and trying to build a life and trying to live it to the best of their potential and desires. And in that context, I almost find it a funny question, to be perfectly honest, to ask what's the advantage of private sector? What's the advantage of your shops that you buy your goods and services from? They meet your needs, right? There's so many unmet retail needs on the continent, and I am going to look at an FMCG play partially there. So many unmet needs, because fundamentally, so many private sectors haven't fully understood the actual consumer needs that are different for the base of the pyramid and for people who live, for example, rurally, very, very far away from urban centers. But there is definitely a power to spend money. In fact, the example that Yvonne brought up, really interesting, of Nigeria. I do a lot of work in Nigeria and financial inclusion. The capping of the rates on financial services has a very dark side to it, because it has meant that it's not financially viable for many financial service providers to go out more remotely, especially in a context where mobile network operators and telcos are not allowed to play in that space, and set up their agents and branches. What you see is that people spend multiples of the capped banking fee to travel to a place where they can bank. Who is saying these people didn't have spending power? Who is saying these people that aren't willing and able to spend? Of course, far less than the pricing of the goods and services for us. So you definitely need to innovate. You need to innovate your product and service offering. You need to innovate your distribution model. You need to innovate your back offices so that you can run this much more efficiently. But the illusion that this is a disillusioned, unempowered group of poor people that are waiting to overthrow these countries into chaos is a framing that I think completely ignores the potential that that group holds.
And in order to fund that group, what we're seeing quite often now is a higher debt level across the continent. And the IMF just came out with some data about this. And this used to be an old story, right? 2 decades ago, several nations just almost frozen out of the financial system. Mozambique, I think it was at 200% debt to GDP, so very high ratio. Then the 90s came along, things started to get better. But now we're seeing not necessarily the exact same situation, but small similarities. And this question might be, to many people, a little bit premature, but do we feel that right now Sub-Saharan Africa is heading back into a debt crisis? And if so, or if not, how can we avert it? And this is for you, Razia.
A little bit of global context, and what we need to realize is that what happens in Africa is not isolated from what was going on globally. The global financial crisis happened. We had incredibly accommodative policy put in place in all of the major economies, and it was cheap to borrow externally. So many African sovereigns did. And for most of them, it has been a very successful experience. Here suddenly was the availability of funds to keep spending on infrastructure. It was a means of keeping growth going when the commodity cycle turned. There has been, in the recent past, very successful episodes of successful maturity extension. That is, countries that had borrowed are coming back to the markets, as you would expect, and extending those maturities. That is entirely normal for any country that has accessed international capital markets. How worried should we be about those debt to GDP ratios, though? What we do know is that so long as GDP keeps on growing, and if it's growing at a faster pace than the debt accumulation, that's a good thing. More recently, investors have been saying it's not just GDP, because how meaningful is the big GDP number? Some countries have such big GDPs, that populous country in West Africa, for example, that you really should look at the debt service commitment and how much that is as a proportion of the revenue that they're collecting. Now, what I'll say, it's almost cliched, but we can't look at Africa as a uniform whole. There are some countries that have certainly got into difficulties with their external borrowing, but there were irregularities in terms of how much they were disclosing, Mozambique in the recent past. There will be many more countries as we come up to the 10th anniversary of quantitative easing. We'll see many more external debt maturities in Africa. And this is going to pose the real test. For countries that are able to access international capital markets easily, they have showed investors, they've demonstrated to investors that they're reformers, and financing is still incredibly favorable. Financing is affordable, it's cheap, they will do well. Other countries who may not have that track record of reform will come under greater pressure. There will be greater concerns about how they're going to pay those maturities if they're not able to borrow again. So what we're saying is, this is an environment where it's all important to reassure everyone that you're putting in place the right reforms. If fiscal policy has been excessively loose in the recent past, now's the time to tighten it. And even though the outlook is good, everyone feels upbeat about global growth today. China's growing, the US is doing well. These are good external factors for African economies. Commodity prices are seeing more support. What we do need to recognize is that in individual countries, governments are going to be under pressure to consolidate their fiscal balance, that is, to close those fiscal deficits even faster. And that could be a big influence on the individual growth trajectories for different countries. So the world looks good, but there's hard work to be done.
And you just mentioned China and the fact that it's growing and how Africa can benefit. For those of you that have been following the news, just past 2 days, the US Secretary of State, Rex Tillerson, is traveling around the continent, and he did make a statement saying that African nations should not rely so much, and I'm paraphrasing right now, on China, and because you'd give up your sovereignty to China. So, Martyn, I'd actually like to direct that at you. What do you think of that statement? Are African nations too over-reliant on China, or will they become too over-reliant, and that is doomsday for them?
Let me give you a bit of an alternative view, perhaps. So over the last 15, 20 years, undoubtedly the mega trend of our continent, arguably, I would argue, has been China's engagement, pervasive, mercantilist state engagement of Africa. So anyone from Venezuela here? Odd question. I'll tell you why I asked the question. There's a lot of people trying to leave right now. Who's been financing the lunacy, the fantasy economics in Venezuela in recent years? The Chinese taxpayer, China Development Bank, China Exim Bank, to the tune of roughly $60 billion US. Who's been financing fantasy economics in Angola to the tune of nudging $20 billion US? Chinese taxpayers. So we call it sovereign wealth, state-directed capital, or the Chinese banking term policy banks. There's an enormous amount, to come back to the debt issue, of hidden debt which exists around infrastructure assets, which is guaranteed by a piece of paper, which in my world is worth nothing, in Yvonne's world is worth nothing, and I get Stan Chart as well. It's called the sovereign guarantee. So if Kabila gives you a sovereign guarantee in the DRC, do you think it's worth much? But it's worth a lot to Beijing. So I'll just on this point, see roughly about 100 Fortune 500 firms, give or take, are Chinese now. That's no mean feat. Of those, vast majority, maybe 95 plus, are state-owned or state-aligned in some form or other. How many of those are present in Africa at any one time, be it investing or contracting or receiving China Exim Bank preferential financial loans? I checked, roughly about 2/3. So you've got maybe say 65 to 70 sort of companies, 2 financiers, China Exim Bank, China Development Bank, 1 shareholder, Beijing. So that engagement of how China has deployed capital to the continent and how it's underwritten the expansion and build of infrastructure could be incredibly economically enabling. But at the same time, I don't feel the national micro business environment and policy has fully taken advantage of that infrastructure as well as it could have. But the conclusion is our perception of calculation of capital risk is very different to Beijing's. And that's my conclusion.
Yeah, go ahead. I was going to direct it to both of you, the same question.
Again, just looking at some of the broader macro influences, we know that recently international capital markets have been open to a lot of African sovereigns. And this is a good thing. Everyone's hoping for a transparent borrowing program. Countries get rated in order to access these markets. And that's good because that's a consistent check on how they might be doing with reforms, with economic growth and the rest of it. But we don't have to go that far back in history to think back to a time when it was very difficult for any individual African sovereign to borrow in international capital markets. There's much more risk aversion. We were in a higher interest rate environment. What changed on the global level to completely turn around people's perceptions, investors' perceptions of Africa? And I think it's very difficult to separate that out from the impact of China. So China's accession to the WTO, the commodity price boom, suddenly people started paying very close attention to that rising level of trade between sub-Saharan Africa and China. And it may have been that Africans were importing a lot of cheaper imports from China. It may have been that they were selling primarily raw commodities to China, but the numbers were staggering. At the peak of the cycle, before commodity prices collapsed, we were looking at trade that in the mid-1990s had maybe accounted for about $5 billion. At the peak of the cycle, it was worth $220 billion. That is huge. And I would say that over that period, also through the indirect impact, China's influence in the global economy, China's influence in helping to bring about these very low, benign levels of interest rates everywhere, this played a key role in completely overturning the traditional undervaluation of African assets in the minds of many investors. So yes, we're looking at a situation today where there are multiple sources of borrowing. There is always a need for transparency. Many of the economies, the different populations will be saying, we want to understand what commitments are being taken on. But at the same time, we shouldn't forget what has changed so fundamentally in the global economy, and that is the rapid rise of emerging markets. China in particular has created huge new opportunities for sub-Saharan African markets.
Add on to that in terms of maybe some disadvantages of those opportunities or concerns?
Not necessarily the disadvantages, but actually putting it in context to who that statement then is coming from. The US-Africa trade, and particularly US aid into Africa, is rapidly being dwarfed by Chinese. So a Tillerson saying, be careful what you're doing with the Chinese. There aren't many things like free lunch. There aren't many free lunches in the world. Aid many donors really like to be recognized for the aid that they provide, but aid comes with strings attached in many, many situations. And many African countries are actually welcoming the opportunity for different sources financing, different sources of capital. And frankly, whilst I'm not an expert on the requirements that Chinese capital places and the way in which it ties or doesn't tie African governments, the assumption that African governments wouldn't know what they're doing and selling their economy and countries and soul over to this like shark cap, that's pretty judgmental. I'm not sure that's actually a correct assumption, and this doesn't come from a neutral actor. In fact, if you look at the capital flows into the continent, these days remittance flows are bigger than foreign direct investments. And foreign direct investment is bigger than the total sum of global aid, of which the US only provides less than 10%.
And I actually want to just continue with you. You have experience dealing with investors, either domestically or internationally. And I know that there are several entrepreneurs here, business leaders, people that are interested in entering the market.
Yeah.
Can you just share some success or failures?
Yeah, absolutely. So let me give you also a little bit of context where I'm coming from. Dalberg is a mission-driven strategy consultancy focused particularly on solving issues of exclusion. So when we think about the economic potential of the continent, we particularly look at including the under or unincluded in various different sectors. So the examples that I would have come from companies that have managed to innovate their products and services to create the relevance that Yvonne quite rightly was talking about, relevance of offering for consumers or for small businesses in Africa that currently is lacking, which means there's a limited uptake of products and services. Sadly enough, when I get asked this question, I keep somewhat going back to the same examples, which to me shows that there aren't enough examples yet. I'm just going to be very honest about that. But a very great example of innovation is Equity Bank. Everybody talks, when they talk about financial inclusion in Kenya, everybody talks M-Pesa. The story of Equity Bank gets told far less. 10, 15 years ago, Equity Bank was a near-bankrupt housing financing society. They reinvented themselves as a retail bank exclusively focused on the un- and underbanked. These days, they are the most profitable, the fastest growing, and the biggest retail bank in the Kenyan banking landscape. And they have shown other banks that it is actually possible to profitably serve the un- and underserved. But you have to be really innovative. You can't just, and I'm not going to mention the bank actually, because I'm going to say something unkind about them, but at some stage I was having a conversation with the head of financial inclusion of one of South Africa's bigger banks. And this person was saying that they had this new product for South Africans at an income level of 10,000 rand a month and less, which is 90% of the South African population. And they had one product. And the uptake was, not very surprising, because that group comprises of people in regular employment, people with informal businesses, people that are self-employed, people with seasonal labor, who all have very vastly different financial needs. But there was this one product for the poor. And then that bank said, we've been trying it, and see, these people really don't want and don't need financial services. Well, they do, but you haven't really made an effort trying to understand what it is they need and innovate to their needs.
Yeah. And that's going to be perfect. I hope you're all paying attention, because I'm going to come to you very soon. We don't have that much time left, but I have one more question on that topic about consumer needs and how much they vary. We've talked about this growing population. I think by 2020, the population in Africa will be larger than North America and Europe combined. And yet you have to deal with so many different classes. And the fact that Yvonne brought it up before, we can't just focus solely on the emerging class. We need to think of the bottom of the pyramid population. How do you even cater? I don't have experience in this. I'm still trying to wrap my head around how you can, even as a business owner or investor, come in and deal with these various or fragmented population. I know, again, tough, big question, but that's for you, Martyn.
Sure. Okay, so I guess, my numbers may be out, but not by much, that in our lifetime, there'll be 2 billion people living on the continent. That is arguably by the time it happens, it'll probably be not too far off, an India and a China combined, considering China's drop-off. Okay. But India sort of stabilizing. That's a lot of people. Now, putting things in a social, political / demographic European context is, and somebody said this, I forget who it was, if you just picture a map of Africa, and if Africa is a champagne bottle, Libya was the cork. And that demographic pressure and the push factors, think climatic, think sort of obviously, labor issues, opportunity, etc. Demography here is greater currently of an opportunity. And I think from a European looking south perspective, you ain't seen nothing yet. Don't shoot the messenger. So, but I got to take issue with this word consumers, and it goes back to what I said at the very beginning. I find it very arguably superficial when we're looking at the continent as consumers, i.e. we want to sell cigarettes or we want to sell sugar water or a beer maybe. I think we deserve better than that. It's more about development, as I said earlier, not about how much small small packages of stuff we can sell these guys. I don't think it's about that. So going forward, I think for me, we use the word inclusive all the time, and I think it's the most. 5 years ago, no policymaker, government guy would use the word inclusive growth. Now you can't go to a conversation on Africa without somebody every minute talking about inclusive growth. What does that actually mean? Two provocative thoughts. The first one is I think the lack of inclusion and related to that inequality that we have to endure in almost all our societies in Africa results often in bad policy, where the state feels it's a need to intervene more and more. South Africa, Exhibit A, where in effect it needs to do less and less or different types of intervention. That's the first point. I think the second point is this notion of inclusion. Ultimately, inclusion is formalization of a labor force, not scratching and living as a rural citizen, but getting 12 checks a year, if you're lucky, 13. How's that going to come about? Leapfrogging to services? Nah, don't think so. So Africa, maybe in certain cases. It's about formalizing a workforce through a manufacturing / assembly type operation. And that's a whole nother conversation. For me, inclusion is diversification, is deeper value chains, and we see what's happened in Europe the last 200 years. I've seen it in Asia the last 50, Japan, sort of, the four smaller economies of Asia, and China more recently, the last generation, of how inclusion has come about through industrialization, assembly, and technical skills. That, for me, is the 2 billion person citizen question for Africa.
Three of you, are you going to be here all day?
Most of it.
Most of it. So there'll be an opportunity for a lot of you to mingle and ask more questions, because we don't have that much time, but I'm going to throw it out to the audience right now. For anybody that does have a question for our three panelists, please raise your hand. And sir, you were the first. Let's get you. And where's the catch it? Yeah, there you go. Can you throw it though? Because it's more entertaining. There you go. And please just, everybody keep your questions really short so we can try to get through as many as possible. The throne is yours.
Can you hear me?
Yes, sir.
Yeah, so my question is for Martyn. Martyn, you mentioned that Beijing, China are willing to invest in some of these emerging market nations, Venezuela, some of the African nations. And you talked about the uptake being quite low from these nations. Just from your opinion, why is that? Is that due to maybe the government's not filtering this information down to the people? Is it the expertise of the people within those economies not knowing how to, take advantage of them? Can you just divulge in a bit more? Why is that? Why is the uptake low?
Thank you.
Sure. Just when you say uptake, let me just clarify. Uptake, I mean in terms of, it's all very well getting a free road, or you'll pay down the line, or a bridge, or maybe some port enhancements. But that's not really impacting upon your structural fundamentals in your economy. What I meant by that, I can hardly think, Ethiopia is the only exception I can think of in recent years and continues, where the state has fully understood how this enabling infrastructure and capital interest and technical interest from China can lay the platform for a deeper, in their case, industrial expansion exercise, export-driven economy. Everyone else is largely reactive or having a nice flagship project there just before election time. And I can tell you many projects around that. So, just to one thing now, and this is an incredibly interesting sort of timely conversation. So when is it? This year, September, I think, we will be hosting once again the FOCAC, the Forum on China-Africa Cooperation. I was back at the first one in 2000, and to see how it's morphed over the last 18 years has been dramatic. And the key thing now for the Chinese, and you'll see it this year, is going to be air infrastructure and open skies agreement. Why? Practically every new airport being built across the continent is built, financed by Chinese capital and built by Chinese companies. Secondly, you see, I was in a two literally small airports recently, the last month, and I saw Chinese pilot training schools at these airports, all Chinese branded, some Chinese planes parked there, training locals to fly. That's great. Then you see investment by HNA into an airline in West Africa, and you see Huawei providing sort of airport services. Interesting. This is incredibly enabling of a broader connectivity, air connectivity across the continent, supporting services and to a small extent air trade. But you see there's no country, in the conclusion, there's no country that has such long-range planning, thought processes as Beijing. And the recipients of this, the strategic game, the recipients or observers don't really understand the dynamics of this.
Hence the United States' recent comments, maybe. No.
Yeah, it's...
contentious topic. We are going to move on to the man in the back raising his hand just because I'd like to see it toss quite far. There you go.
Okay.
Sir.
Thank you so much. So the conversation on the involvement of China in Africa is very interesting because China has changed the game and there's been significant growth and we cannot deny that. And we're going to see a lot of growth continuing to happen. But how do we ensure that the growth that's going to happen is going to lead to the benefit of Africa as well as the people on the continent in terms of the economic growth and, say, skilling of individuals? Say, are we seeing a lot of people that are learning new skills by the coming in of the Chinese companies? And how do we then protect the interests of the African nations? We've got the example of the reported bugging of the African Union buildings that were built by the Chinese government. And so the question now is, you're looking at a lot of countries, small countries, that are dealing with one very big country. Should we be looking at a consultancy company working with African governments at the African Union level, or should we be seeing SADC and the other regional blocs negotiating contracts with China as blocs so that they can increase their level of muscle? What should we look at for the future?
Razia, that's for you.
Thank you. Maybe I'll touch on the first point about how African economies ensure that they do see the benefits and how we do see the trickle down of that, because that's important. And then maybe handing over to Martyn to expand a little bit more. But there's been a lot of discussion today about the multiple sources of financing available for Africa. And we do need to put this in perspective. One of the positive aspects that we saw of that post-2001 growth spurt, when we started to talk a lot more about Africa rising, was that we started to see a much higher level of investment in Africa, and it was generally backed up by an increase in the amount of savings as well. Something changed after the crisis. The investment levels were sustained on that higher trajectory. We saw a big deterioration in overall savings. If something does need to change, it's about more long-termism in the African context as well. You can't continue with that kind of gap, that kind of imbalance indefinitely. For now, foreign investors from around the world, and this goes back to those multiple sources of capital, are happy to keep on investing in these rapidly growing economies in Africa. The demographics of Africa speak for themselves. That will continue to be a key source of attracting the capital. But I think a lot more thought needs to be given to resilience, to how to make this sustainable. And on this issue of, yes, there is capital available, but is enough being done with that? Is it being used in a good way? Is there the transparency that everyone wants to see? Is there the ease of repayment that should be in place? Or are there issues that we haven't even started to think about? That is a key one. But related to this, the benefits to the individual. We've spoken a lot about the larger external borrowing on private markets, on traded markets. We've spoken about the sources of financing from the likes of China and other emerging markets. There's still something to be said for aid because it is one of the only sources of capital flow that has an explicit pro-poor dimension to it. So I think we should be looking to an Africa where all of these different sources of capital have their place. There is always some role, some function that has to be fulfilled, and we should be cautious when it comes to dismissing one particular source of capital just because another happens to be more fashionable.
Yeah.
Maybe I will ask you to keep that in your head right now, and then we'll move on to another question, just so we can give some more time to some other people. But
Okay.
I'm sure your insights are all well respected. Let's go, you, sir, all the way in the back. Yes, you, pointing at yourself. Yes. Toss it. There you go. Oh.
Hi. You mentioned manufacturing as a way of inclusion and bringing jobs into the continent. With production costs being so high, what investments and policy changes do we need to make that an attractive option?
Ethiopia has lower labor costs and a better labor productivity expressed in cost than Bangladesh and Vietnam. They are very high in South Africa. I would be more concerned about lower value-added manufacturing in South Africa right now, and I wouldn't move in that direction in terms of investment. Maybe Martyn has a different perspective, but Ethiopia, Rwanda, again, you know, this is not one country, and some countries are better set up to immediately grow those kind of industries than others are.
Just two quick stories. So in December, it was my daughter's 9th birthday. So she wanted a new bike.
Daughter like father, right?
So I went to the bike shop. She had one choice.
Yeah.
Anyway, we went to the bike store, and she so it was like it's a very cool green bike she liked. Okay, great, no problem. And just looking at the bike, and under the bottom bracket there was a label, made in, guess where? No, that's old news.
Yeah.
2 years ago it was made maybe in Vietnam. This was made in, first time I've seen it, Cambodia. I'm like, WTF, how did that happen? How did this get to South Africa? And why is it not made locally? Well, you kind of touched upon it, but it could be made on the outskirts in Bole Industrial Park in Addis. You know, it should be. The problem is this African industrialization story is totally false. Because as a landlocked African economy, you've got no hope. Absolutely no hope. Because bad infrastructure is highly inflationary. You know, and the story of Asia has been incredibly enabling infrastructure. But manufacturing is really hard to do and to succeed at. It's really hard. Everyone talks about it, but it's really, really hard. And I think, as you say, Ethiopia, I've spent a lot of time in Ethiopian factories in the last couple of years. They're amazing. Not like your typical Bangladeshi sweatshops at all. These are really professionally run operations. But the only economy for me, which is doing a China circa 1990, i.e. very high labor absorption, mass employment, albeit low level, but 12 checks a year, that's great, and moving up that sort of garment, textile, clothing, footwear, light industrial space, is Ethiopia. I don't really see anywhere else, to be honest. Maybe Morocco, but that's a whole other story.
Last question. You, burgundy shirt. Yeah. Stand up then if the microphone is. Can it get there? Just because we're recording,
watch your
so
head, it keeps you on your toes. Huh?
yeah.
So I believe that remittance flows to sub-Saharan Africa are the greatest in the world. So my assumption, and I could be completely wrong, is that that's targeted to the lower base of the pyramid. So my question is, if it's the greatest, then what's happening to those funds? What's happening to the money?
It's being used in consumption. Like those are people-to-people flows. So it's the one person in the family that the whole family put money together for to get a really good education, that went abroad and got a good job and is now sending money back to take all the cousins and nephews, etc., through school. So it's directly plowed into consumption, which is a beauty of that capital stream because it actually doesn't prescribe in any way, shape or form what it's being used for. It's being put in the hands of people that then can make the most of it. It's also one of the disadvantages of it because, as the other panelists are rightly saying, there is still a need, and there's quite a big need actually, on the African continent for a certain degree of public goods and for investment in an enabling environment to make all of that innovation that I spoke about possible. And remittance flows aren't going to go into that. That needs to be done by public actors that have a public mandate to do so. But if you ask where is that money going, straight up into people's pockets, into their consumption pattern, to pay for education, to pay for healthcare, to pay for transport, to pay for their basic consumption needs.
And that's unfortunately got to be it for the time being. We are going to go out for coffee. This is the time to talk about these topics. Take it online. The hashtag is OxfordBFA. And I'd like everybody to give a round of applause for the panelists. Thank you, guys.